Hey YouTube, we are going to go over Paycom software, ticker symbol PAYC. Yesterday, company was down 38.5% after reporting their earnings, and earnings were okay. Guidance was not ideal for shareholders. And we'll go over a little bit of that guidance they gave to us in here in a moment. Year to date, company is down 50.5% over the course of 1 year, 56%. So in their earnings yesterday when they reported, they missed on revenue just barely by $476 million, or sorry, $4.76 million, and beat on their EPS. Since then, analysts have revised their forward-looking numbers, their EPS revisions down. All 14 analysts covering this have revised EPS lower. So in the report, they had some good news. One of the things they reported was they have $1 billion remaining under their buyback authorization. A quarterly dividend of 0.375 cents per share payable in the middle of December. So pretty decent. So turning to the balance sheet, they ended the quarter with a very strong balance sheet, including cash and cash equivalents of $484 million and total debt of only 29 million. The average daily balance funds, client funds was $2.1 billion. We'll go through that real quick on the balance sheet too to understand a little more. I think they actually have a little more depth than what they're saying they do. So the guidance they gave to us throughout 23, they've been seeing moderating upsides to their guidance model, which corresponds with increasing embedded usage and macro headwinds from inflation that may impact each client differently. Now that more clients are achieving the ROI that Betty has to offer, which is their relatively new software that allows their clients' employees to do their own payroll. So it's saving companies a lot of time and money on with this particular software, and we'll go over that in just a minute. So because of this, it has eliminated certain billable items because of the efficiency of Betty, which is then cannibalizing a portion of their services and unscheduled revenues. So this software that they created is cannibalizing part of their own revenues. So it's kind of if it's eliminating your revenues, your own software is eliminating your own revenues. Your goal is to eliminate the competition's revenues, which they still might be doing if you think about it. Because if they are able to prove and show that this particular software is that good, that could give them some future pricing power. So if you look at it from a different side of perspective, in the shorter term, this might look really bad. But if it's that good and it's proven to be that good, which it seems to be, because a lot of their clients are switching over to this software in the last 2 years. I think 2/3 of their clients have switched over to this Betty software, and sounds like every single one of them love it because it's saving them a lot of money, especially right now. Obviously, a lot of businesses are trying to save money in every area that they can. But with the 10 months of data from increased Betty usage, we are incorporating the impact that our clients' return on investments achieve has on our model. So based on these factors, we expect fourth quarter 23 total revenues to be in range of 420 to 425 million, still representing a growth rate of only 14%. However, they have forecasted saying that they have no reason to expect anything less than 20% in the shorter term future. Now they're forecasting, now they've grown only 14%. And then they're forecasting for fiscal year 24 to only be between 10 and 12%. So they're cutting their revenue forecast growth in half, still forecasting growth, but just not 20% like they said they would. So that really crushes the valuation of this business forward looking. One thing they know is that how much this strengthens the value of their clients receiving from the Betty. So because of that, they're making strategic performance and client value decisions that we feel are best for a long-term relationship with their clients. So I don't know. I think this is in the short term not great, but in the long term, I think this could be really good and could push a lot of competition out of the market since there's like 200 plus competitors in the marketplace for this particular type of business model. So here we can see in this little paragraph the success of their Betty automated software. Betty has allowed customers, employees to initiate payrolls by themselves. And because Betty has been so effective and accurate, it has reduced the need to further use Paycom's other software to correct payrolls. So because of that, it's eliminating certain billable items, which is what's cannibalizing some of their revenues. And then management gave an example where a customer was previously running 19 payrolls in a quarter, but has reduced that number to 13 because of the effectiveness of Betty. So it's saving the customer money. But yeah, that sucks for Paycom's revenues in the shorter term, but if this can actually get some traction and other companies take on and adopt Betty's software or Paycom software Betty, this could actually be a really good long-term move on this company. Although in the shorter term, we see this as very bearish and not exactly what we wanted as shareholders. I'm not a shareholder, but based as if I was a shareholder, I see this actually being a long-term likelihood of this thing actually having some pricing power behind it. Because if this is the only company, if businesses can save money on just payroll itself, I think there could be a pretty good widespread adoption on that particular software. Let's take a look at Paycom's financials here. We have revenue, gross profit, net income. All three are trending higher. Obviously, still forecasted next year to continue to grow only at 10%, not at 20% as most analysts had anticipated or forecasted. Gross margins sitting at 84%, net margins 20.8%, so decent margins. Return or revenue and gross profit year-over-year change, we are going to obviously see this come down to about this range here next year, but still we have growth. Return on invested capital, 22%. PE ratio currently at 25.7. Earnings yield, 3.89. Would really like to see that a lot higher. And here's our cash to short-term debts. Again, we're going to go over that on the most recent earnings release because these charts are inaccurate based on their holdings on their balance sheet. We have net income to free cash flow. We do have a little bit more free cash flow than net income, but we're talking $51 million, not a big deal. We can see stock-based compensation is going to be majority of that. So free cash flows, we have 390 million in free cash flows and is just continuing to trend higher. Capital expenditures maintaining about 120-ish million there, 120 to 130 million dollars for capex. Share count, we should start to see this decline. They are buying back shares. They have a buyback program, and since there's a massive decline in the shares, I would be shocked if the company is not buying back shares right now, or at least in the near future, because of their 40% decline in share price. So on their balance sheet, right here, we can see here's our most recent release. Funds held is what we're talking about. So we've got $1.9 billion in assets for funds held, but we come down to here, client funds obligation, same thing. We get to deduct that off of our balance or our liabilities, and our total liabilities is $2.4 billion. So right here, we can take 2.43 minus 1.9 gives us $530 million in total debt. Now, if we deduct out deferred revs as well, that leaves us with about $400 million in total debt, which is typically what I do. Now, the liabilities that they're talking about is right here, long-term debt. They're only claiming $29 million in long-term debt, but realistically, company has a lot more debt that's owed to people beyond just $29 million. So they've got $484 million in cash, and if we deduct out deferred revs, it leaves them with $400 million in debt, or we can leave the deferred revs in, leaves them with $530 million in total debt, but they're still doing plenty of free cash flow to cover their debt. So balance sheet, very strong, especially if you add in a little bit of free cash flows that they do produce. 4 other companies here that I put in for comparables. Down here, we got all 5 companies to compare to. The first 3 on the board, we got Payc, PCTY, and CDay. Those 3 are more comparable than the other 2 on the board here. Those first 3 there are more direct competitors compared to ADP and WDay. So we can see where revenues, gross profit, net income are on the board. All 3 of them are kind of close in terms of revenue, profit, income, all that. Same thing over here on our market cap to revenue. We can see our market caps across the board are pretty similar. We got 10 billion, 9 billion, and 8 billion. So almost within $1.5 billion market cap difference. 5-year growth rate on EPS and revenue. This is likely going to get cut in half. This has yet to be adjusted based on their most recent earnings because they just came out. Gross margin 84%, operating margin 28%, profit margin 20.8%. So on the board here, we have the best margins under Payc. Free cash flow on these best free cash flow. Return on invested capital, the best return on invested capital based on these 3 companies. PE sitting at 27, earnings yield 3.89, best earnings yield on the board there for those 3. Over here to the calculator, we have Paycom valuation. I changed their average EPS growth rate to 15% and a revenue growth rate to 10%. I left the next year 2 and 3 alone. So forward looking for the next 3 years, we're looking at about a 19% growth rate EPS, revenue growth of 16.5%. That gives us a Peter fair value of $102.80 per share. We're going to get rid of C Day because they have a PE of 2,700. And we're going to get rid of W Day because it's a negative. So that gives us multiples comparison price of $252.50 per share. We got our manual PE. We take our market cap minus cash, add in debt. We could probably actually change that to like 500 mil versus 2.4 bill. Either way, it's still telling us we are undervalued or fairly valued, just slightly above fairly valued. But if we were to deduct out $1.9 billion that this company kind of shouldn't be claiming as debt, that would really put us significantly undervalued on a manual PE basis. Price to book, 5-year average 23.3, currently sitting at 6, PEG ratio 1.64, forward looking 1.08, and we can see here that basically currently fairly valued, forward looking almost undervalued. Graham's valuation, because of our change in growth rate projection, that gives them an intrinsic value of $116.85 per share. Company does offer a current dividend. However, they just began offering a dividend, so there is no dividend growth rate to compare to give us a dividend, an accurate dividend discount model. Discounted cash flow valuation. Analysts are projecting 21%. I'm going to anticipate that dropping in the near future here once analysts have revised their numbers. Their history is 36%. I gave them 15% for a growth rate on free cash flow. Gives them a price per share of $186.40. Rule 72. We have 3 sources for an EPS growth rate over many years here, and that gives us an average of 14.3. That goes into 72 5 times. That goes into 10 years, basically 2 times. So that'll give us a future EPS of 22, and that gives us a fair value today of $157.25. Over here at the summary, currently Payc is trading for $147.59. Market is now open, so that has dropped since we've previously during this video. So now it's sitting at $147.59. Fair market value that we get is $162.95, 30% margin safety, $114.07. Analyst price target is $276. I would definitely assume that to trend or at least come down quite a bit based on their recent earnings report and forward guidance. Over here at the stock chart on Payc, so the market is open currently and we are heading lower. However, we have these two trend lines here. We are now on the weekly chart. We can see we're sitting below 147 or 150 here. And so we're in this channel now between support and resistance. We got support at about $115 per share. And we've got resistance at about $158 per share. So now we are in between this channel. What I'm going to assume, I was actually assuming today we might see a little bit of a bounce, a little bit of a, dead cat bounce, come back up to maybe 150, 160, or sorry, 160-ish range. We did not yet. We probably doesn't look like we're going to. Was anticipating a little bit of a bounce and then maybe a rollback over, headed down to $115 per share. Right now, it's looking like we might just head straight down to $115 per share for, a bit of a fade and maybe sit there until we get some confirmation of where earnings and forecast is going to end up. But it's looking like that. Typically the market does, ready, fire, aim, and then I don't know, maybe where they're going to aim for $115 per share, and we'll see where this ends up. But right now, I would not buy Payc today. I would wait. I'd wait till this thing comes down to about $115 per share, find some support, bounces around here, and then maybe we get some clarification on some future earnings before we want to pick up some shares on this company. So in the meantime, I would sit on the sidelines, just keep an eye on it, put it on your watch list. If it hits $115 per share, you can consider starting a position. But if it gets below $115 per share, I don't know where the next support range really would be on this company. You could probably potentially say it might come down to, $55 per share. I doubt that, but anything's possible in the stock market. If it does, that would just be a better buying opportunity on this particular company. But that is it on Payc. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.